Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to find the juicy bits. Today we're diving into MSC Industrial Direct Count Inc.'s latest report, and let's just say they've been busy making some significant changes to their borrowing arrangements. Before we get into the nitty-gritty, if you're all about understanding what these financial reports really mean for your investments and the companies you care about, make sure you hit that subscribe button. And for more exclusive insights and to join the conversation, our Discord channel is linked right down in the description below. So what's the big news here? MSC Industrial Direct Counting, or MSC as they're commonly known, which is a major player in distributing industrial supplies across the United States, has updated its primary credit agreement. Think of this like restructuring your home loan, but for a massive corporation. It's all about how they borrow money to keep the business running smoothly and growing. The main event here is Amendment Number 3 to their credit agreement. Now, amendments sound technical, but what they really mean is changes to the original deal. In this case, the deal's a big loan or credit facility that MSC has. This amendment was signed on July 16th, 2025, and it's a pretty significant update to a loan that was originally put in place back in April of 2017. One of the most important things they've done is extend the deadline for paying back a huge chunk of money. We're talking about a $600 million unsecured revolving loan facility. Now, what does that mean in plain English? An unsecured loan means they didn't have to put up specific assets like buildings or equipment as collateral. It's based on their creditworthiness, and a revolving loan facility is like a flexible credit card for businesses. They can borrow, repay, and borrow again up to a certain limit. They've pushed the date they need to fully pay this back all the way out to July 16th, 2030. This gives them a lot more breathing room and flexibility. They've also tweaked the rules for how much interest they pay. This performance-based pricing grid means the interest rate they charge might go up or down based on how well the company performs. They've tied this to something called the consolidated net leverage ratio. Basically, it's a measure of how much debt the company has compared to its earnings. If the company's earnings are strong and debt is low, they might get a better interest rate. If things get tougher, the rate could go up. It's a way to link the cost of borrowing directly to how well the business is doing operationally. Another change is the removal of a credit spread adjustment to the interest rate. This sounds a bit complicated, but it essentially means they've simplified the interest rate calculation. Previously, there might have been an extra little bit added on top of the base interest rate that could fluctuate. By removing it, they're likely aiming for more predictable borrowing costs. It also looks like some of the banks or financial institutions that loan them money have been swapped out. This can happen for various reasons. Maybe some lenders wanted to exit the deal, or MSC and its administrative agent found better terms with new lenders. It's quite common in these large syndicated loans. And they've added a new feature, a $50 million swingline loan sub-facility. A swingline loan is a short-term loan, usually advanced very quickly, often to cover immediate cash needs. Think of it as a quick cash advance that can be drawn down and repaid very quickly, making the overall credit facility even more flexible for day-to-day operations. Adding even more flexibility, MSC now has the option to ask for up to 2 one-year extensions on that new maturity date. This means if things are going well, they can try to push the repayment deadline even further out, giving them even more strategic runway, but the banks have to agree to it. Signals item 2.03, creation of a direct financial obligation or an obligation under an off-balance sheet arrangement of a registrant signals. This update to their credit facility means MSC is creating or changing a direct financial obligation, which is why it's also being reported under this section. It's essentially saying, hey, we've modified a major borrowing agreement and here are the details. It's a commitment that directly impacts their balance sheet and how they manage their debt. Signals by Signals Kirsten Actis-Grant Signals. This report is officially signed off by Kristen Actis-Grant, their Executive Vice President and Chief Financial Officer. This tells us that the company's top financial mind has reviewed and approved the filing, confirming the company's financial strategy and commitments. Now, this isn't a report packed with a lot of detailed financial tables showing revenues and profits, which we often see in 10Q or 10K filings. This is more of a specific announcement about a change in their financing structure. However, the context of this change is incredibly important. MSC Industrial Direct is a massive supplier to businesses, kind of like the backbone for many manufacturers and maintenance operations. Their ability to access and manage credit is vital to their operations, allowing them to buy inventory, invest in technology, and manage cash flow. By extending their credit facility and making it more flexible, MSC is essentially strengthening its financial foundation. This longer maturity date and added swing line facility suggests they're planning for the long term and want to ensure they have stable, accessible funding. It's a move that signals prudence and a focus on operational continuity and potential growth. Think about it this way: if you had a mortgage coming due in 2 years and you were able to rewrite it to have payments spread out over 7 years instead, that would free up a lot of your monthly cash flow. For a company like MSC with potentially billions in assets and operations, managing this kind of borrowing is a huge part of their strategy. This amendment is their way of ensuring they have the capital they need on terms that work for them for the foreseeable future. While we don't have their latest revenue or profit numbers in this particular filing, this credit agreement amendment is a strong indicator of management's confidence in the company's future. They wouldn't be extending debt if they weren't planning to use that capital for profitable ventures, or if they were worried about their ability to repay. Another way to look at this is through a Warren Buffett lens. What would he pay attention to? He'd likely consider this a positive step in ensuring the company's financial health and stability, which is a prerequisite for long-term value creation. He'd also be interested in the cost of this borrowing, the interest rates and fees, and compare them to industry benchmarks. The fact that they're moving towards more defined pricing and removing some adjustments suggests they're seeking clarity and perhaps better terms, which is always a good sign. What are the risks or opportunities here? The opportunity is clear: improved financial flexibility, lower potential borrowing costs if performance improves, and a stronger safety net for unexpected needs. The risk, as always with debt, is if the company's performance falters. Even with extended dates, they still have to repay this debt, and increased leverage always adds a layer of risk. However, by securing these terms now, they're mitigating some of that risk by aligning their financing with their long-term outlook. In conclusion, this filing is all about MSC Industrial Direct strengthening its financial backbone. They've essentially refinanced and improved their access to a significant line of credit, giving them more stability and flexibility. It's a move that suggests management is looking ahead and wants to ensure the company has the financial muscle to operate and potentially grow in the coming years. It's a solid, albeit technical, move that underpins their operational strategy. Alright, that's our decoding of MSC Industrial Direct's latest moves in the world of corporate finance. What do you think about this strategic refresh of their credit facility? Does it signal confidence to you? Let us know your thoughts in the comments below. And if you found this breakdown helpful, smashing that like button really makes a difference. And don't forget to subscribe for more in-depth analyses. Remember, our Discord community is the place to be for more insights and discussion, and it's linked in the description. Thanks for watching, and we'll see you in the next decode.